We're definitely seeing a combined rally. And I think you and I talked about this a month ago, is when the gold miners are leading the way, as you just mentioned, that's a really good sign for physical gold. It's one of the reasons why we've entered a new gold position, is because seasonality wise, we're in favor. The whole cycle of the economy shows we're still in this major topping phase where gold and precious metals come to life as a global safe haven play. And of course, now miners are taking the lead and shooting higher. And usually if that's the case, physical gold and silver want to keep going much higher for quite some time afterwards. So, and silver could do the same. I think we could potentially see silver actually spike up and hit that $50 an ounce.
Chris Vermeulen has been closely watching the action in precious metals, and he points out that the leadership shift from physical gold and silver to the miners is a major signal of strength. After months of underperformance, both gold and silver mining stocks are finally waking up, with large-cap miners hitting multi-year highs and junior silver miners experiencing a sharp uptick in volume. This type of rotation, according to Vermeulen, usually means the foundation of a bigger rally is being built. When capital begins flowing into the miners, it often suggests that investors are preparing for a sustained move higher in the metals themselves, creating a bullish feedback loop across the entire sector. Vermeulen also emphasizes the importance of the structure we're seeing right now. In past cycles, rallies in gold and silver were often led by large-cap miners before the juniors exploded with gains. That's exactly the setup unfolding again, and it comes at a time when global uncertainty and de-dollarization trends are already fueling safe haven demand. The seasonal backdrop only strengthens this case, as precious metals historically thrive in periods of stress and shifting central bank policy. With money now spreading from the most stable mining plays into riskier juniors, the market appears to be entering the early stages of a broader structural bull run, rather than a short-lived bounce. Looking ahead, Vermeulen believes the upside targets are significant. Gold is increasingly likely to push into record territory, forcing global investors to chase the momentum. Silver, often slower to react, could then play catch-up in spectacular fashion, with the next major target near $49 an ounce. If this cycle plays out like previous ones, the miners, especially the smaller cap silver names, stand to benefit the most, offering outsized returns compared to the metals themselves. The real question for investors now is not whether gold and silver are heading higher, but whether they're prepared for the type of explosive rally that could redefine the precious metals market for the next decade. Now, we present the clips from Chris Vermeulen's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
We want to see miners leading the way, and they haven't been until the last couple of months, and now they're taking the lead. We have SILJ, which we've been long for several weeks. It's potentially set to close at an all-time high. Actually, I think it closed at an all-time high last week, but it's continuing to push higher. There's huge volume in it. We're long gold. I think these are plays that the fact that they're breaking out is really interesting. It's interesting how the silver small caps are hitting. I don't know if these are all-time highs. I don't know if this ETF goes. Oh, it's not quite all-time highs. Pretty darn close.
Close.
But we got the large caps, as you had mentioned earlier. GDX is closing at a new monthly all-time high, going back 14 plus years. This is a good sign. Money is definitely moving into the more stable large caps, and then I think we'll see the gold miner juniors maybe play catch up and really start to pick up speed here. They might actually start to take the lead. I think the large caps have led the way, and now I think people are going to be starting to look for, okay, what hasn't popped and taken off quite as much, and maybe the small caps for gold miners start to pick up speed. Yeah, we're definitely seeing a combined rally. And I think you and I talked about this a month ago, is when the gold miners are leading the way, as you just mentioned, that's a really good sign for physical gold. It's one of the reasons why we've entered a new gold position, is because seasonality wise, we're in favor. The whole cycle of the economy shows we're still in this major topping phase where gold and precious metals come to life as a global safe haven play. And of course, now miners are taking the lead and shooting higher. And usually if that's the case, physical gold and silver want to keep going much higher for quite some time afterwards. So we're in that kind of sweet spot for precious metal traders, and this is the time to enjoy it.
Yeah,
it's in a zone here where we're going to probably hit some new all-time highs, and we're going to keep having fun with these miners and gold itself. That's the nice thing about like using Fibonacci extensions that we showed. Like it shows there's two upside targets. Every time you have a new pause or pullback, you can re-gauge where that next move should go, those next two upside targets. So for silver, it was $49 an ounce is kind of the next stop. And so that's the nice thing about technicals. And if you use the proper tools, you can project where that run should start to run out of steam and take a bit of a pause or breather. And if it does take a pause or breather, usually when it hits those targets, I trim off. I lock in gains. I'll move my stops up. And then, of course, it'll have a pause and or hiccup. And then if it starts to turn and starts to rally again, I can quickly draw the new extension and be like, okay, this is breaking out of this little bull flag, and this is the next upside target. So using technicals allow you to trade where price has never been before. And Fibonacci, I find, is really the only and the most powerful tool that works for not only markets hitting highs, new all-time highs, but also to figure out where support is, where it should bounce or hold a trend. So it works really well. If I had to pick, really four things to trade the markets, it would be the 20-day moving average and the 5-day. More or less, if the 20-day moving average is sloping up and the 5-day moving average is above it, you're in an uptrend. If the 5 days below it and there's trending down, you're in a downtrend. That's like a swing trading style. Just identify a trend. And then, of course, use Fibonacci extensions so you can figure out your targets to the upside. Use Fibonacci retracements to find out where support is, where a pullback should hold. Those are the four best things. It allows you to be aligned with the trend, and then also know where support and targets are. And that's really the only way to gauge, unless you're just going to buy and hold, which I'm not a fan of.
Right.
That's just how you navigate the markets, really one market leg at a time. Every leg allows you to recalibrate. Where's the next leg after that? And you just kind of take it one step at a time. So let's use the weekly chart first. Let's look at the big picture so we understand where the big underlying trend is. So obviously there's a big consolidation here, and we've got a low through here. We had a big rally up, and then we've got a significant low here before it went into a huge pause. So that'll give us a couple longer term upside targets. And this is the one thing I've always shared with you, Craig, on here is when you hit this 618, that's called the golden ratio. Yep. When there's a pause at the 618, you almost always go up and hit the 100% measured move after that.
Yeah.
So 153.44 is the next upside target for this. Now let's drop to the daily chart and we'll get a bit of a gauge on this one here. So I'm just going to get rid of this line. So we just kind of got a bit of a cleaner chart to look at. Let's just take a look where we're at. So there's a couple different little bull flags here. It doesn't look like there's a really clean one to go off of. There's a rally and a pullback here. This one here looks more significant based on this type of move. We could say that this is a leg up, this is a leg down. We could carry that forward. So just based on the momentum, I know there's a lot of lines on here, but this is based on this rally up, this pullback, saying it should hit this 618 and then go all the way up to 151.90. So there's two targets, a weekly chart that goes back a long time, plus the daily chart. So if it gets to 151 or more or less 152 to 153, there's a couple patterns saying there's going to be sellers there. People are going to be selling. There's going to be overhead resistance based on that momentum.
Gold's recent surge above a long-standing resistance level has shifted market sentiment dramatically, and Chris Vermeulen emphasizes just how significant this development could be. After months of consolidating beneath the $3,500 mark, a level that had been tested repeatedly, gold has now managed a decisive breakout. This is not simply a technical milestone. It represents a shift in investor behavior, where former resistance now transforms into firm support. Vermeulen explains that while short-term volatility, particularly around key economic data releases and Federal Reserve announcements, may create temporary pullbacks, the broader trend is firmly to the upside. With strong volume accompanying the move and confirmation during regular trading hours, the breakout appears to be legitimate. If gold maintains this momentum, the path toward $4,000 becomes increasingly realistic, with the potential for acceleration if broader equity markets falter, creating the conditions for a classic safe haven surge. Silver, while historically more volatile, is beginning to mirror this bullish momentum in its own way. Vermeulen highlights how the metal has spent months climbing steadily within a channel before recently breaking above it, signaling strength and momentum that could propel it much higher. Applying Fibonacci extensions, he identifies a potential rally into the $49 to $50 range, levels that echo silver's historic peaks and carry psychological significance for traders. A move into this zone could spark a short squeeze, amplifying gains as bearish positions are forced to unwind. Vermeulen notes that gold may remain the more stable and reliable trade, yet with silver miners already surging, the stage is set for both metals to enter a powerful, synchronized rally that could redefine the precious metals market in the months ahead.
Weekly close kind of above this resistance area. There's news coming out on Friday. I think we got jobs or something like that. Mm-hmm. The Fed announcement potentially, that'll help them decide whether they're going to do a quarter basis point cut, which will dramatically move all kinds of stuff. Obviously, stocks, interest rates, bonds, gold. So we're really close to. It's going to be a volatile week in the market. And I think gold could easily pause or pull back. It might take a little bit of a hiccup here. It could come back and settle into these highs. But overall, the momentum looks like it's shifted to the upside. Mm-hmm. It looks like a very clean break today, the way the markets are moving, or really it was a break on Friday. I mean, I like to look at the ETFs. You and I touched on this in the last session. If you look at the Sprott ETF, this only shows regular trading hours. And I like it when the market breaks above, was going to close above these highs. I said, if it could close above these highs from several months ago, that will be a very good sign. And so we had that on Friday, and now the market is popping and breaking out. So it looks like a legit breakout what I like about regular trading hours, Craig, is this is when the majority of volume trades. So this is, to me, is when it closes here during regular trading hours, it means there's enough volume and it's willing to hold overnight and continue to move higher. So it looks like gold's breaking out. We're looking at about a 6%, about 5% upside to our first target, and then about 15, 18% to the next target. And that could happen very quickly. That could happen really just in 1 to 2 months, potentially less. I think we're very close to the end of a stock market, the rising stock market. And when it does start to fall off a cliff, this is when gold can have that parabolic move and shoot higher and potentially blow way past that. I mean, we had a similar setup like this in 2008. It was looking like gold was going to rally about 20%. It ended up rallying 37% because we hit this tipping point. At major turning points in the market, you have blow off tops, you have capitulation, panic, washout lows on a market bottom. And so we might be at that major turning point. So gold might hit 41, but it could spike and go way above it. And silver could do the same. I think we could potentially see silver actually spike up and hit that $50 an ounce. When you look at the chart of silver, especially when you look at the monthly chart, all these charts are very bullish looking and pointing to, a final blow off and a squeeze way up here. And silver, as you know, can be a rocket ship once that trains. We could look at a couple different levels of where silver could go using Fibonacci extension. We could take a low here. We could take this run up here and down to here. And this shows where silver could potentially pop and rally to, which is about $49.
Imagine that.
And of course, that brings us back. You go back in time. Yes, that's pretty much the previous peak, give or take a buck or two. At that point, if we start to shoot up there, there's going to be probably a huge spike in price, probably pierce through 50. It's going to want to run the shorts out if there are any up there, or the short squeeze will cause it to rally. So there's quite a bit of upside potential just from where we are right now. It's about 16%. And I mentioned this to you last time. I'm like, it's funny because silver and gold actually have roughly the same amount of potential gain based on the technicals. And I like gold because I find I win a lot more trades. I have a much higher probability with chart patterns gold, the way I trade gold. So if they have the same upside potential, I like gold because it doesn't have the shakeouts, the fake outs, and the volatility, and we can make the same amount of silver. So that's my take. I like them both, but I think gold to me is the more logical play, just because it looks like it has the same potential upside without the noise to it. But silver miners are popping and really ripping higher too.
If the current momentum in gold and silver continues to build, the next phase could bring dramatic price movements that catch many off guard. A sustained breakout in gold would likely drive it into uncharted territory, pulling in new waves of capital from institutions and retail investors alike, while silver's explosive nature could trigger rapid surges once key levels are breached. As confidence in traditional markets weakens, these metals could shift from being viewed as defensive hedges to becoming aggressive profit engines, with money pouring into miners and ETFs at an accelerating pace. The effect would not just be higher prices, but a shift in perception, where precious metals reclaim their role as core assets in global portfolios, potentially setting the stage for a historic bull run that redefines their place in the financial system. Would you be ready to ride that kind of move if it unfolds? How do you anticipate the price trends of gold and silver evolving in the near term? Share your thoughts on experts' analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.